Today we'll discuss Module 3, Effective Summarization of Case Study. Here we have 3 modules. We have already completed 2 modules. Final one, Module 3, Effective Summarization. Within Effective Summarization, here as part of the syllabus, concluding complex problem, time awareness, relating parts of the whole, and case study is the fundamental thing of this module. Within case study, using our technical knowledge, professional experience, our evidence, analysis of support conclusion, and we have to use the valid and different technical skill, formulate option, advice, plans, solution, option and reservation also within our case study, and making decision and recommendation in unstructured situation in which risks and uncertainty may exist, and specifically the criteria of the most appropriate proposal we should approach to our top management through the case study, assigning the cost and benefit that may be flow from the decision, approach decision making using the ethical framework also, and we have to recognize the time constraint and prioritize the given tasks, preparing, describing outlay, advice, report notice, and clearly we have to take different types of style, and we have to describe the interrelated issue within the complex scenario of a case study. This way, we have to complete our case study. So here is a model case study using the answer script provided. We know our case study is 4 hours exam. Typically 1 hour for the study and decision making. How we will start our case study. So here instruction we should read the carefully. Answer would be in English and answer part by part, but in a case study all requirement based on the sequence. So here is a case study, just if we study it. One of group, FY group. So first we have to understand who am I. Here said that senior manager, your role within this case study. Every case study giving the role in a first para. So here you are a senior manager who works in the finance team, report directly to your chief financial officer, and your role include giving advice on a special project and a strategic matter. So what is your role is describing here. Your role is giving advice to a specific project and a strategic matter, and your boss is chief financial officer of that FIR group, FC. While you're saying the background of that group or companies, fundamental phenomena here. So FIR group is established 1996 as a garment trading business. In 1997 is redirected, is focused on the first piece, food and beverage. Firstly, it started the garments trading business. Then they focus after 1 year of the establishment, first piece food and beverage industry, and it started its first food beverage chain. That means few shops is here, chain market. In spite of this 1997 Asian financial crisis, which had far-reached negative economic impact within the Asia, FIR group overcome extreme odds and traveled in the time we saw many other FB outlet closed down. That means in the year 1997 and Asian financial crisis, within that crisis, lot of that type of business, they shut down their business. FIR group choose to focus on its dynamic and innovative style of management in order to distinguish itself from other FB companies. So it's some specific different style. It consistently offer customer in Dhaka a taste of the latest international dining trend. However, management of the FIR group had always placed and still does a strong emphasis to understanding what the partners wanted and to be sensitive of their need. all this paid off handsomely. FI Group grew into a star in the local restaurant sense, giving it much-needed beverage and became a formidable player to the international FB market. In 2007, FI Group had a total of 9 brands under the umbrella. It served the 9 brands under the umbrella, namely FC1 to FC9. On 10 April 2008, it launched its 10th food brand, FZ10 at Dhanmondi, Dhaka. It had diversified its business and is now involved in its brand food import in the distribution and business to business, B2B is also the e-commerce, B2B, business to business, suppliers and even catering. In terms of the market, it has outlay in Singapore, Malaysia, Philippines, China, Hong Kong, and the United States, just to name a few. The pipeline of the plan to extend into Russia and other part of the world. So this business, they already opened their business, Singapore, Malaysia, chain business, Hong Kong, United States even, they are going also Russia. Looking for the further future, FI Group intended to remain commitment to its global growth through rewarding partnership with the business associate. So let's take the global business, and while it continues to be vitally engaged with the communities in the part of its aim to be global FB industry player with roots enhance their fast growth. So it is the company's background and their strategy. Here the mission of that group, mission and goal of the FI Group. FI Group has a very simple and concise mission statement which summarizes the FB company's direction and goals in one easy to remember sentence. That is, to provide good quality food and excellent service at the best value. This is their mission statement. So what is the mission statement? Their mission statement is to provide, this is the mission statement, to provide good quality food and excellent service at the best value. In this simple sentence, we see 3 key values being expressed, namely 1, to provide good quality food, 2, to provide excellent service, and 3, taking food experience in the whole new level. Now, vision of this group. It was the mission and goal and the mission statement. Vision, where the mission statement of FI Group guides the working principle with the company. The vision statement helps to steer the long-term direction of the company. It is to build global brand. It is the vision statement. To build global brands. This expresses the ambition of the derived management team of FI Group. This group's core value. The core value of the FI Group are attempted summarize of the acronym is EPIC, which EPIC means here excellent, productivity, innovation, and comparison. Excellent in our minimum standard, productivity in everything we do, innovation to simplify, and complete comparison to all. Company's culture. FI Group started as the entrepreneurial venture, but it has not forgotten the value innovation in the creativity that propelled the company's achieve a cultural success today, which employee to ensure to the push. So here saying that the company's culture is, with this innovation culture, the FI Group hopes to achieve global success. Corporate customers. Who are the customers of that company? FI Group is considering relaxing its tight credit policy. Considering relaxing its tight credit policy So when we will study, then we will mark it, the key point, in the light of the current market development. The change in policy will result in increase the average collection period 30 days. That means 1 month to 60 days. So is a policy change. So that for our working corporate customer, if I is considering relaxing its tight policy, they have the tight policy, average collection period was 30 days. Now they extended it for the 60 days. Review of the credit policies expected the increased sale in each year amounting of 25% of the current sale volume to corporate client. So within the corporate client, if the credit policy change this policy, 30 days to 60 days of average collection period, then their sale would be increased amount 25% in a year. Selling price per unit of consumed product is 30 taka, variable cost per unit 23, so margin is taka 3. Current annual sale 6 million, or we can say 60 lakh. The required rate of return of investment is 28%. In 25, increase of the sale will result in the additional stock level taka 2,50,000 and additional account payable 50,000. So within this scenario, our requirement is that within this case, so that requirement is case by case here. Sometimes that types of case study, all requirement within the after completing the all cases, but sometimes within the case that requirement can be fixed. So here fixing the requirement within this policy, provide your expert advice on whether to extend or not to extend prior to the customer. If all the customer take the longer credit of 2 months, the marks is here 7, and existing customer do not change their payment terms, and only the new one did 8 months. So what is saying here, if all customer take the longer credit, that means this credit is 2 month credit. Another option, existing customer do not change their payment terms. So existing customer, they are taking 30 days, but new customer, they're taking the 60 days. So here saying that provide your expert advice. Where you will provide to your CFO the expert opinion. So in this case, if we go for the solution, this is the another problem here. There are a lot of cases here within the case, 100 marks here. Only we are discussing for 15 marks. Look here, the model solution of this case study. All customer take the offer. If all customer take the offer, contribution sale ratio, what would be? 30 taka sale price, 27 taka is our, 30 taka is sale price, and 27 is our variable cost, 3 taka is our margin. So 10% contribution sale ratio. Increase in the sale revenue, 25% of 6 million, that means 1.5 million. This same revenue will increase if the policy change. Increase in the contribution, how much contribution will increase? This 10%, if we multiply this increased sale revenue, 1.5 million, then we'll get here 1,50,000. Increase in contribution, 1,50,000 taka here contribution will increase. Extra investment in all account of customer receives 60 days. How much extra amount we have to invest there? Average current receivable after increased sale here, our 212, that means 12 month, this means 1 year, 2, that means 60 days means 2 months. So 7.5%, that average accounts receivable. How this? Here 6 million and plus 1.5 million to 7.5 million is our total customer now, all customer. So here average accounts receivable increase after the increased sale, it would be 12,50,000 or 1.25 million. So current account receivable 6 lakh, for 1 month 5 lakh. So increase in accounts receivable increase 7,50,000. And then increase in inventory as part of the question 2,50,000. So total 1 million, that means 10 lakh. So let's increase in accounts payable. That payable if we minus, then here come 9,50,000. So return on investment is 15.8%. Return on investment 15.8%. So it's have the specific return. We will go with the question. If we see here, required rate of return investment is 28%. But as we calculate, it's come only 15.8%. So in this case, we can say that this investment, that means that policy should not be changed. And number 2, extra investment if any new accounts receivable within 2 months. In the second, their condition was that existing customer, they will take the 1 month credit policy, but a new customer, they will take the new policy for the 2 months or 60 days. So what would be the increase of accounts receivable in this year? So new customer is 1.5 million or 15 lakh. So for the 2 months, here required 2,50,000 and inventory increased 2,50,000 as per the question. So here total 5 lakh, and within this 5 lakh, if we decrease, that means our payable, then we'll get 450,000. So return on investment here 33.33%. So here partial is taking the new policy and partial, that means existing customer, they are within the previous policy for the credit policy for the 1 month. So what would be the decision? Here is the decision. Write this decision to your CFO. Number 1, the policy is worthwhile if the existing customer is stuck to the 1 month and new customer or account take 2 months. So here saying that the return on the latter 33.33%, which has crossed the required rate of return 28%. So this second option should adopt or accept for the policy. So it is your decision or advice to your CFO. So we have completed 2 items here, and the total as per the question, model question here, 15 marks we completed here. Now another one, investment decision appraisal within this project, within this group also. If a subsidiary is considering purchase a new incumbent that will improve its incumbency efficiency 90% and against the current 50%. So efficiency will be increased to 90% from the 50%. So it is the highlighting thing. Then the which is the purchase immediately will cost 1,20,000. Its life is 4 years. Scrap value 10,000. The current contribution of Taka 3 per day old chicks. The number of day old chicks sold 12,000 unit per annum will increase by 80%. Fixed cost will be 20,000 per annum. If we have after tax cost of capital 12.5% and tax of the year profit made rate 15% per annum, nominal tax rate. The firm is also entitled to capital allowance at 25% of reducing balance. So this is the condition, and from this figure we have to calculate net present value and the viability of the investment, 10 marks. And also we have to calculate internal rate of return of this investment. It's also 10 marks. So if we go for the solution, this is the solution here. It is the NPV calculation from the, here is the taking the cost, capital allowance, reducing balance method. tax gain calculation, additional gain here calculation, and this way after calculating, we will get the net present value, 10,576. And same way we will calculate the IRR. Here calculation is here. So after this formula, if we can calculate 15.67% IRR. Next thing, blue chip subsidiary. So blue chip, we know generally sell high quality, widely accepted product and service. Blue chip companies are known to weather downturns and operate profitability in the face of the adverse economic condition, which helps to contribute to their long record to establish the reliable growth. A venture capital is an investor. So it is saying that what is the blue chip? What is the venture capital? So here saying that venture capital is an investor who either provide capital to a startup, venture, or support a small companies that wish to extend but do not have the access to equities market. Two blue chip subsidiary company of FIR Group, FIRM and FIRN. So FIR Group have two blue chip company, raise fund from venture capital, boost production in their order, satisfy demand for their new product, solar power refrigeration. So there is a new product and air condition system which they develop through a joint venture. They have consultant you for advice. Explain 5 conditions that a venture capital will consider in accessing an application for funding. There are 5 marks. So it's the theoretical answer. So if we go for the answer, explain 5 conditions that venture capital will consider in accessing an application for funding. So venture capitalist, what is? Venture capital will evaluate proposal for funding based on number of criteria, including nature of the company's product, expertise in production, then expert in management, the market and competition, future profit, board membership, and risks brought to the existing shareholder. So etc. are the fundamental thing venture capital will process. Before processing any proposal, venture capital will see that type of item for further processing, for giving the funding to the company. And then if we go another item, foreign exchange management of the FIR company. As a CGA, you have been appointed as the finance manager of FIR Limited and they expected to the board for the EU to provide education and working solution for their foreign exchange losses problem. So first take was the provide basic knowledge to the board foreign exchange losses, how foreign exchange loss occur. So here requirement is that here 4 items, each items 3 marks is also theoretical. How will you explain the following? Foreign exchange risks, transaction risks, translation risks, economic risks. So here, foreign exchange risks, this is transaction exposures, risks, this is the translation risks, and this is the economic exposure risks. So here, foreign exchange risks is the risk of change in the foreign exchange rate or the value of a currency. The level of change or movement cannot be determined with certainty, making any counterparty with the exposure in be exposed to the market volatility or uncertainty. So it is the foreign exchange risks. And if we see the transaction risks, this transaction risk says that one is transaction, another is translation. So transaction refers to the gain or loss made in foreign exchange transaction due to the change in the exchange rate. Here, a factor is exchange rate between the transaction date and the payment or settlement date. Exposure transaction is unhedged. And translation risk refers to the movement of the value, either gain or loss, of the balance sheet due to the consolidation of the asset and the liability in the reporting currency from various currencies. And economic exposures risks refers to the long-term change in the value of the foreign firm due to the unexpected changes in the exchange rate movement. So this is the all risks where, as per the question, this answer is 12 marks, theoretical. If we see latest one, cost of equity. One of the FIR's subsidiary is a listed company of Dhaka Stock Exchange and show the following performance. The following information was made available in that 31st December 20. So current market price per share, Taka 10, dividend per share for the year 2020, Taka 1, and expected growth rate of dividend 20% per annum, the average market return 27%, the risk-free rate of return 24%, the beta factor is 1.4. So here saying that what is the estimated cost of equity using the dividend growth model is one thing, marks is 5. And what are the expected cost of equity using the CAPM method, that means CAPM model, 3 marks. So here 2 calculation was for dividend growth model equity. We have to calculate the cost of equity using dividend growth model. Also, we have to calculate the cost of equity using the CAPM model, because here beta, risk-free rate, market risk, everything is here. So if we go for the calculation, only few just here. This is the formula for model QE DO1G divided by PO plus G. If we put all things, PO decimal 10 and growth rate 20%, that will get here 32%. And using the CAPM model, cost of equity would be, we know the cost of equity formula is cost of equity as per the CPFA model, risk-free rate of return plus beta multiplied by market risk minus risk-free rate of return. That if we put all data here, that means here risk-free rate of return to 24% and beta 1.4 and market risk is 27%. So here we putting all data, if we summarize, we will get 28.2%. So you have completed 2 items, what is equity and what is CPM formula. Now, big one here, this is the consolidated statement. Within this figure, we have to calculate this one, here 35 marks. Prepare the consolidated statement of financial position, a statement of change in equity, consolidated statement of profit and loss of a year ended 31st December 20. Muttaqin is 90% subsidiary of FY Limited. Was acquired 1 year ago for 4 billion when the retained earnings Muttaqin were 800 million. Below are the financial statement of the companies. Both are, one is FY is the parent company and it is the Muttaqin is the subsidiary company. So they have the revenue, cost of sale, gross profit, distribution, administration expense, etc., tax, profit for the year, all is including here. And also here the statement of financial position, here saying previously it was the statement of the profit and loss. And this one is the statement of change in equity, that is balance sheet. Here the investment and other things is here, total asset and liability is here. And additional information here, during the year, if we are sold goods, Muttaqin 100 million, these goods are sold margin 20%. So intercompany transaction is here. So we have to consider this one. During the year, Muttaqin sold good 180 million. These goods are sold markup 50%. And at the end of the year, there was no outstanding where intercompany current account balance. So that type of few situation is here. So from that situation, if we go to the solution, then we'll see here First, we have to calculate the stake group structure. This is the working one. So here, FIR is the group, parent interest is 90% of that Muttaqin company, and non-controlling interest is 10%. So here, the acquisition was 1 year ago, and so there will be no need to time adoption the result of Muttaqin because previous year already did it. So here, FIR to Muttaqin. So here, unsold inventory at the year end, 1/4 of 100 million multiply gross profit margin 20%, it comes 5 million. So unsold inventory at the year end, half of 180 million, gross profit margin, this one, so 30 million. And this way, we have to calculate the net asset of both company, the acquired acquisition company and post-acquisition. And post-acquisition profit here come 1.32 million. And we have to calculate the goodwill here. All is calculating here. You should do it in your draft khat also. So here the statement of financial position after consolidation. All working is coming here. W, that is working. That this working. W8. 8 working is here within this math. And then we have to calculate the profit loss, consolidated profit and loss. That means FIR groups. So also same way, the total profit and loss, that one. And this one is a statement change of equity for the year 2020. Same way we have to calculate it. So this is the 35 marks is here. Another one here, after adding 35, that means 95 marks already completed. Now remaining 5 marks, 200. So this part marks is here. Financial reporting. The financial reporting is the process. Here just describing what is financial reporting. Saying that what is the difference between financial reporting and financial statement? What are the main objectives of IFRS? As a professional, integrate financial reporting of FIR group with the requirement 1 to 8 because this requirement is number 9. So you already completed requirement of 1 to 8. So if we go for answer, is just the theoretical. You can make answer from that question also because all is within the question describing there. So this is with our answer. Only 5 marks. The difference between financial reporting and financial statement. The financial reporting and financial statement are often used interchangeably. But in accounting, there are some difference between financial reporting and financial statements. Reporting is used for the provide information for decision making. But on the other hand, a statement are in the produced financial report are the normal format. The main objective of IFRS is as per the IFRS Foundation. We know IFRS, International Financial Reporting Standards. The objective of IFRS Foundation are to develop in the public interest and single set of high quality, understandable, enforceable, and globally accepted financial reporting standards based upon clearly articulated principle. This is the main objective of financial reporting. So if we see here, look this model case study. If we see this model case study, so what is the learning of this case study? Within this case study, first, we have to study the instruction of the question because we will get 4 hours, 1 hour for the reading, thinking, and determining. We have to read total case study very carefully because each and every line, there some instruction. Based on that instruction, we have to write down the everything. This case set up very easily because all requirement within that point. But sometimes our case study, all requirement within the last time. That time we have to find out all of the item. That's why when we study or reading that type of case study, first we have to mark the key point, which they asking, what is the key point. You can write in different color also for understanding. So here we learning there. Here this company says that mission, vision, mission statement, core value, company's culture, corporate customers issue, and the credit policy changing issue, investment decision with a subsidiary company. Here we also take the capital budgeting issue, NPV IRR. Also we understand the blue chip subsidiary, venture capital. Also here the foreign exchange management, how the different risks, what is the risks within the foreign exchange. Also we have to we calculate the cost of equity in different model. One is dividend growth model, another is cost of equity model, that means capital asset pricing model. Also consolidation here, consolidated financial statement, 3 items here. And also we have seen here financial reporting. So I think and that type of case study, more or less big or small, 5 page or 10 page, 9 page or 12 page, it may happen. It's no problem. I think